Hi everybody, on today's session we'll be looking at financial objectives and also the financial management function. On today's session then we'll be looking at a general overview of what we mean by financial objectives. We'll then move on to look at company objectives, stakeholder groups, performance measurement, and finally we'll finish off briefly looking at not-for-profit objectives. Okay then, let's start then by thinking about looking at this in overview terms. So with reference to financial management then, what do we actually mean by this? Well, financial management focuses on the managing the finance of an organisation. Now the aim then of a financial manager and financial management is to support the organisation in achieving their financial objectives. Now, the finance manager then of the organisation is responsible for the finance function, and they will be expected to make decisions which are based on the following three areas: financing, investment, and dividend policy. Now let's think about each of these in turn in a bit more detail. So what do we mean by financing decisions then? Well, ultimately, this is about how the organisation actually gets their hands on the money. So we need to consider the different sources of funding that are available to an organisation. So predominantly in here, what we're thinking about is the different forms of debt and equity which might be available to an organisation. Secondly then, when we think about the investment decision-making process, this is all about how we use the money in the organisation. So how the organisation uses funds that it has access to within the organisation, not only for long-term decisions, but also for the short-term decision-making process. And then finally, we've got dividend policy. Now, dividend policy is all about how the organisation pays out the money. So this is about the organisation making decisions on how they reward their shareholders, but also not forgetting about the fact that they will need to retain some of that funding for the future operations of the organisation. Now, when it comes to financial management, it's important that we understand the link between those three types of decisions. So first of all then, stage one, if you like, is we need to make sure that we secure sufficient financing. So it's going to be up to the company, it's going to be up to the financial manager to decide on where they get their money from and essentially what sources of financing are actually available to them. Now, one of the things that you cannot forget at this particular stage is that all financing is going to have some costs attributable to it. So for example, debt financing will obviously have interest attributable to it. Equity financing, there will be some costs associated with the dividends that are actually paid out on that. So it's about getting that balance right. Once the business has funding, it must use it appropriately. They must make sure that they use it sufficiently, effectively to generate appropriate returns. Now, we need to be a little bit careful in here because it's not just about, as I mentioned before, the long-term financing. It's also about making sure that we're in a position where we are controlling our working capital as well. And then finally, the third and final stage of this is we need to now decide on what we do with the returns which have been generated from the investment. So what are we going to do? How are we going to repay those providing the finance for us? How much of that financing, how much of those returns we're going to keep hold of and reinvest back into the business. So we have to think about how much of it is going to be retained for the future. Okay then, so making decisions then. It is absolutely key for any decisions which are based around financial management that we analyse the financial data to determine the best course of action that the organisation could take. Now, the whole idea behind this is that the organisation would then be able to monitor and assess that they have met their objectives. Now, some of the questions then that the finance manager may have to answer include the following, and these are quite far-reaching. How much cash is needed to run the business? How much will we need on a day-to-day basis to ensure that we've got efficient, effective business operations? Is there a need for new non-current assets in here? How are we going to invest in those non-current assets? Are we going to use our cash? Are we going to lease those particular assets? Which projects do we go for? Project A, Project B, which of those has the highest return, and therefore which one would be the most applicable for us to undertake? How much of a return is required by the business to make an investment worthwhile? How do each of these investments that we undertake actually pay for themselves? Should we take prompt payment discounts from our suppliers, thinking about their working capital? What is the best source of financing for the organisation? Is it debt? Is it equity? Now, the financial data then will come from management information that is already used in the business operations, and it will come from that information which is used to produce financial accounts and also management accounts as well. Okay, so let's have a look at a question based on this area. Which of the following then would you expect to be the responsibility of financial management? Producing annual financial statements, advising on whether to invest in non-current assets, or C, reviewing variances in overhead costs. Finally, D, recommending pay rises for staff. Now, the solution in here, guys, is advising on whether to invest in non-current assets, because that will be a typical decision that the financial management will have to make within an organisation. It is a key part of financial management, and it falls within the scope of investment decisions that the organisation makes. Now, producing annual financial statements, no doubt you will be aware, is associated with financial accounting. Reviewing variances, that would fall under management accounting. And finally, recommending pay rises, that would fall under the responsibility of human resources. Company objectives. Okay then, so with objectives and strategy then, what do we mean by this? So an organisation then will have a mixture of objectives that they will pursue, which can be categorised into a number of different areas. Financial objectives or corporate objectives. Now, the key thing really to understand here is that when we talk about objectives, what we're really thinking about is targets, missions, and goals. That's what we mean by an objective, very much high level. Now, in terms of strategy then, strategy is the way in which an organisation is going to pursue and achieve those objectives in both the short and the long term. Essentially, the strategy is the plan of action that the organisation will adopt to achieve the overall objectives. Now, this strategy has to be broken down, and it can be broken down into 3 different levels within an organisation. You could have a corporate strategy, and a corporate strategy relates to the whole organisation. A business strategy will relate to a particular market or a particular business unit. And your operational or functional objectives will relate to a specific department. Now, let's look at each of these in turn in a bit more detail. So with financial objectives then, we've got to think about this from a number of different perspectives really. So as a shareholder of a business, you hope to receive a share of the profits of that particular company that you've invested in. Profit is an indicator of how the business is performing, and many people will actually use that as a basis. Profit maximisation, therefore, is one example of what we might refer to as a financial objective. But we have to be a little bit careful with this because prioritising profit can impact on other measures of value within the organisation. Now, a short-term increase in profit could actually result in a fall in the share price. So that will obviously lead us to a situation where the shareholders are essentially worse off overall. So let's think about this scenario. So Torch Company then has a challenging profit target which was set in the previous year, and it was communicated in the previous year to the shareholders. They generate more profit than they did in the previous year. However, they still failed to meet the target that they had shared with their shareholders. Now, what this is going to lead to then is disappointment from the investor's perspective because they are not as high as expected, and therefore they could well lose confidence in Torch Company. Now, what might that lead to? Well, it could lead to our shareholders selling on a number of their shares. And if that is the case, the confidence in Torchco therefore will reduce. So therefore, the price associated with the shares will fall. Now, the following year then, they realise yet again that they're not likely to meet their targets. So they decide to reduce some of their expenditure. And this includes expenditure on research and development activities. Now, don't get me wrong, that will lower the expenses, which will then mean that the profit increases. However, performance in future years is therefore going to suffer. There's going to be less research. They therefore may fail to actually develop new products as quickly as their competitors. So a short-term decision here is going to have long-term adverse implications. They could fall behind the competitors, makes them less attractive. They might have a less attractive product range, and ultimately that could lead to a loss of market share. Now, profitability will therefore fall as they continue to lose customers. Now, the share price then, as you can probably appreciate, is also likely to fall as well because, as I mentioned previously, these investors are losing confidence in the company and they will choose to invest with competitors instead of Torchco in this situation. Okay, so let's think now about looking at this from a more practical perspective, and we're going to think about shareholder wealth, and we're going to think about looking at some techniques that organisations may well use to help to assess their position. Okay, so shareholder wealth then. So rather than just concentrating on maximising profit, a better, more appropriate financial objective would be to maximise shareholder wealth. Now, shareholder wealth comes from a couple of different perspectives. One, it will inevitably incorporate the dividend that shareholder actually receives. But on top of that, it will also include the market value of the shares that they own, because ultimately they could choose, if they so wish, to actually sell those shares on. So the wealth of shareholders then increases when the share price goes up. So when the company then makes a profit, it can pay these out in dividends or can reinvest them back into the business for the future profit growth for the organisation as a whole. So what do we mean by shareholder wealth, and predominantly what is total shareholder return? Total shareholder return is the measure that incorporates money received from dividends alongside changes in a share price. Now, it's calculated as follows. So you would take your dividend paid plus your change in share price divided by your share price at the start of the year. Let's have a look at a question. Right, a shareholder purchases then 100 shares at their market price of $4.75 on the 1st of January. Now, on the 31st of December, their holding had a market value of $498 ex-div, and they'd received a dividend of 32 cents per share. What is the total shareholder return per share? Okay then, so total shareholder return then is, as we know, calculated by taking the dividend paid plus the change in the share price over the share price at the start of the year. Now we've got to be a little bit careful in here because we need to make sure that all of the figures that we're actually using are on the same basis. So the closing market value that we've got there is in total at $498. We have to therefore calculate that per share. So if we've got an overall value of $498, if we've got 100 shares, that is $4.98 per share. So in that respect then, our total shareholder return will be the dividend paid, which was 32 cents, plus the change in the share price. So the fact that the share price has gone up from $4.75 to $4.98. And then we would divide that by the shareholder share price at the beginning of the accounting period, so $4.75. So that tells us then that we've got a total shareholder return of 11.6%. Now, another measurement that we can use then is earnings per share. Now, a company may aim to increase their earnings per share. Now, what is the earnings per share is probably the best thing to think about first. Well, it's the theoretical maximum dividend that could be paid out to our ordinary shareholders once all the other implications and obligations have actually been settled. Now, as you probably are aware, earnings per share is widely used as a measure of performance and allows investors to compare results over a period of time, so over a period of several years across different companies. Now, how do we calculate it? It is the earnings which are attributable to our ordinary shareholders divided by our weighted average number of ordinary shares that existed within the accounting period. Let's have a look at some numbers. Okay, Cameo has an objective to increase their earnings per share. Now, extracts from their financial statements show the following. So we've got 2022, we've got 2023, we've got the earnings attributable to our shareholders in both of those periods and the number of ordinary shares in issue. What is the growth then in earnings per share in absolute and relative terms? So when we talk about absolute terms, we're looking at the monetary value. When we talk about relative terms, we're looking at it on a proportionate basis. So to calculate our earnings per share growth then from one year to the next, the first thing we're going to have to do in here is calculate what our earnings per share is for those first two periods. And again, we're just going to use the standard formula for this. Earnings attributable to our ordinary shareholders divided by the number of ordinary shares. So last year, 2022, it would be the $6.3 million divided by the 12 million shares. So we can see that that comes out at 52.5 cents per share. This year, we would take the 7.5 million in terms of our earnings and again divide that by the 12 million shares. So we can see that there has been some growth in our earnings per share because it's gone from 52.5 cents to 62.5 cents in the current year. Now, in terms of this, we can see that the growth has taken place in absolute terms then. Absolute growth is calculated by taking the current year minus the prior year and it's expressed in dollars. Relative growth, on the other hand, is calculated by taking the absolute growth divided by the prior year and this is expressed as a percentage. We calculated that the earnings per share in 2022 was 52.5 cents. In 2023, it was 62.5 cents. So our absolute growth there, as you can see, is 10 cents. In relative terms then, we would take the absolute growth, which was 10 cents. We would divide that by the earnings per share of the previous accounting period, and we could see that the growth there as a proportion of the previous period is 19.05%. Okay, corporate objectives then, just a couple of things to mention here in terms of non-financial goals. So there are some non-financial goals then that the organisation may well pursue. They are relevant for the organisation as a whole, and they relate to key factors for the business's success. So examples of these non-financial goals then could be growth, increasing market share, diversification of products and entering new markets. It could be based around the quality of the products that they actually produce, or it could be based around customer or employee satisfaction and the welfare of those employees. Stakeholders. Now, it's absolutely imperative for any organisation to ensure that they get the balance right in terms of their different stakeholder groups. It's not just the shareholders who've got an interest in the company. A stakeholder is any individual or group whose interests are directly affected by the activities of that company. Different stakeholders, therefore, will have very different goals and very different objectives, and this can often lead to conflicts within those stakeholder groups. Now, different stakeholders then will have different levels of influence over the objectives and the strategy of any entity. Now, let's think about the different types of stakeholders. So we've got our shareholders, and predominantly, as we've already seen, those are interested in their return and ultimately their shareholder wealth. Directors, managers, they're going to be interested in running the organisation on behalf of the shareholders, but they're also going to be interested in the return that they can generate for themselves. Employees will be interested in their availability of their job role and making sure that they're in a position where they feel comfortable and confident that their employment will continue for the foreseeable future. Customers are going to be interested in knowing that the goods that they require are going to be delivered in a timely and appropriate fashion, and suppliers will want to know that essentially they're going to get paid. Not to forget then about any of our governments, because governments will be interested in taxes. Now, one of the key things, guys, that you need to be really aware of is what we mean by agency or agency theory. Now, an agent acts on behalf of a principal to make decisions or take actions on their behalf. Now, a prime example of this then are directors and managers of a company. Ultimately, they are given the power to make decisions and take actions to run that company on behalf of the shareholders, because the shareholders are not actively involved in the day-to-day activities. Managers act as agents on behalf of shareholders who are the principal in terms of the relationships that exist. Now, when we're selecting objectives then, there is a risk, a really significant risk, that managers, directors will actually act in their best interest rather than that of the interest of the shareholders. And this ultimately leads to what we refer to as the agency problem. Let's look at this in a little bit more detail. So one of the issues could be that instead of maximising shareholder wealth, management may try to increase their own pay or increase their own benefits. Now, ultimately, this would then contradict the shareholder objective, because it would in fact increase expenses, reduce earnings, which are available therefore to our shareholders. They might look at maximising short-term profit, because this in effect could actually trigger a bonus for those managers or directors. They could look to minimise dividends to increase funds which are available for the business as a whole for reinvestment. Now, we've got to try as much as we possibly can to align the objectives within the organisation. So to overcome this conflict then, we need to aim to align the interests of management and those of the company and its shareholders. How do we do this? Well, we monitor the activities of management. We measure progress. We measure the performance of the entity. We give rewards and incentive schemes for management, which again, just to stress, do not contradict the overall objectives of the entity and the shareholders. The monitoring of management then is a core component of most corporate governance regulation, and measuring performance is absolutely a key component. Rewards and incentive schemes then should be tied to indicators beyond just the profit that the organisation will generate. So let's think about corporate governance in a little bit more detail. So what is it? So it's the system by which companies are directed and controlled. Now, what do we mean by directed? Decision making within the organisation. What do we mean by controlled? Monitoring and the evaluation of progress. Now, the UK Corporate Governance Code 2018, which is referred to as the UK Code, sets out best practice for those appointed to run a company. Now, objectives then of corporate governance. What's the whole idea behind it? What we're trying to achieve? Well, the objectives of good corporate governance is to strengthen the systems and the controls within a company. Now, this in effect will therefore improve the effectiveness of this organisation. Guidance focuses on responsibilities and activities of the board of directors, in relation to decision making, accountability, fairness and transparency. Now, something else to just consider briefly, stock exchange listing requirements. Now, corporate governance is a lot more strict, it's probably fair to say, when it comes to stock exchange listings. So a stock exchange then, as you will no doubt be aware, is a marketplace where debt and equity instruments of a company are traded. Companies then, with their shares or their debt for the sale on the exchange, are termed listed companies. Now, to ensure that we've got fair and efficient operations, there will be rules and regulations to follow in order to become and to stay listed on the stock exchange. Now, many listed companies then are therefore required to follow the UK Code. Now, we briefly talked about before about incentives and rewards, and there's nothing to say that directors shouldn't have incentives or rewards, or senior management, but we need to make sure that any rewards are fair and do not contradict the overall objectives of the organisation. So the theory is that if performance towards defined objectives is formally measured and good performance is rewarded, individuals will be more likely to focus on achieving those objectives. So we must ensure that rewards are appropriate and also achievable, because if they're not achievable, then that could have the adverse impact and it could actually lead to demotivation. Now, good examples or common examples of this then would be things like performance-related pay, share options possibly, remuneration incentives. Let's talk about these in a little bit more detail. So performance-related pay, this is a bonus usually linked to the size of profits and or reaching a particular share price. Share options, this is where an employee is given the ability to own shares in the company at some point in the future based on a fixed price. Now, increases in share price increase the value of those options, so employees are incentivized to work towards increasing the market share. Performance measurement. Now, measuring performance then is absolutely key, because it's important to regularly evaluate how the company is performing to assess whether or not they are moving towards their objectives. Progress then can be measured by using something that we refer to as ratio analysis. Now, what is ratio analysis? Well, it involves comparing and quantifying the relationships that exist between financial figures. Comparisons, therefore, can be made between a number of different elements: previous years, other companies, and the industry as a whole. But one thing to just stress at this point is that ratios on their own are meaningless. You have to have something to compare with to ensure that you've got some value added. We're going to have a look at some key ratios, and we're going to start off by looking at performance. Performance is often referred to as profitability. So the first calculation then is our return on capital employed. So this is calculated by taking your profit before interest and tax and dividing that by your capital employed. Now, capital employed can be calculated in a number of different ways, all of which will lead you to the same figure. So you can either calculate it by taking your equity and your non-current liabilities, or you will get exactly the same figure by taking your total assets minus your current liabilities. Now, what does this measure? Well, it shows us the return that is generated for every dollar of capital employed in the organisation. So it shows how well the directors of the organisation are using the capital employed, the long-term investment, to generate profits. Next then is asset turnover. So asset turnover is calculated by taking your revenue divided by your capital employed. Now, what this actually shows us then is the amount of revenue that is generated per dollar of long-term investment, hence capital employed in an organisation. We've then got our gross profit margin. So gross profit margin is gross profit as a proportion of your revenue. Operating profit margin, which is your operating profit as a proportion of your revenue. Now, both of those calculations show us the profit that is achieved from the revenue that we've generated. One looks at the gross profit, so that is before any additional non-direct costs, and one shows us the operating profit, which is our profit before interest and tax. We then have our return on shareholders' funds. This is our profit after tax. Now, notice that we're taking after tax in here because it is the profit essentially which is distributable to our shareholders, and we would divide that by our shareholders' funds. Now, shareholders' funds is the equity that exists in the entity. Profit after tax then, remember, can be abbreviated to PAT, profit after tax. And then finally, we've got our return on equity. So return on equity then, earnings attributable to our ordinary shareholders divided by our shareholders' funds. Now again, shareholders' funds in there is the equity that exists in the organisation. Now, the second set of ratios then are our liquidity ratios, and we've got a couple of typical examples in here. So we've got our current ratio, which is our current assets over our current liabilities. So what this shows us then is the number of times that our current liabilities can be met from available current assets. Now, what we've got then is a variation on this, and that variation is our quick ratio. So our quick ratio then is our current assets minus our inventory over our current liability. Now, what do we mean by quick ratio? We look at the assets which are quickly convertible into cash. So hence the reason that we do not include inventory in here, because inventory can take quite a long time to actually turn into a cash position. So it is the quickly convertible assets that are considered. We've then got our inventory days. Now, these actually show us the average age of our inventory. So we would take our inventory over our cost of sales multiplied by 365. As I said, it shows us the average age of our inventory. Inventory turnover then, the number of times we use our inventory. So this is your cost of sales divided by your inventory, the number of times that you are using inventory in a period. Receivables days gives us the average age of our receivables. Receivables divided by credit sales multiplied by 365. Now, a point to note on this is that you may not be given your credit sales in an exam question. So if you haven't got that, then all you're going to have to use there is your total sales, so your revenue position. Payable days then, this looks at the flip side of this. So this looks at the average age of your payables. Payables over credit purchases, again multiplied by 365. But again, you may not be in a situation where credit purchases are available. So if that's the case, you would just use your cost of sales figure. And then finally, we've got our sales revenue as a proportion of our net working capital ratio. This just takes our revenue divided by our receivables plus our inventory minus your payables multiplied by 365. So it shows us the average time it takes to generate our revenue. We've then got our investor ratios, some of which you have seen previously of these. So you've got your dividend yield, dividend per share, divided by the ex-div market price per share. Ex-div means ex-dividend, so meaning without the next dividend in there. Cum-div means cum-dividend, meaning with the next dividend. So we must make sure that we are using the ex-dividend price, which if you're given this, fine, you would just use that figure in the question. However, they may tell you what your cum-div price is, and therefore you'll have to adjust that for the forthcoming dividend that's expected. EPS, earnings per share, we've already seen. So this is the profit that's available to our ordinary shareholders over our weighted average number of shares. And then we've got our price earning ratio. So price earning ratio, market price of shares divided by your earnings per share. Just on that point, guys, remember earnings per share, you have seen that previously. Earnings per share is the shares available to your ordinary shareholders divided by the weighted average, as you can see there at the top of the screen. We've then got our gearing ratios. Gearing ratios then look at how the organisation is financed. So we can look purely at the financial gearing here. Debt divided by equity. So this can be calculated using the figures that are included in your statement of financial position, or depending upon the scenario, you might use market value in here. So just be careful about what the question's actually asking. Now, another way of looking at this is to take debt as a proportion of all of the financing in the business. So taking your debt and equity. And again, you could use statement of financial position values or market values, again, dependent upon the scenario. Now, in both of those situations, then, what we're looking at trying to do is measure how the entity is financed. So with financial gearing 1, we're looking at debt in proportion to equity. With financial gearing 2, we're looking at debt as a proportion of the total financing of the organisation. We've then got operational gearing. Operational gearing then, this looks at sort of the day-to-day activities in the organisation. So this shows you your contribution as a proportion of your profit before interest and tax. So this is looking at the contribution that's been generated, okay, the contribution that's been generated in the period as a proportion of your total profit before tax. And then finally, we've got interest cover, and interest cover is an interesting one because it actually shows the number of times that interest payments can be met. So it can be used in conjunction with your gearing because it looks at the affordability of debt finance. Not-for-profit objectives. Okay then, so far then we've been concentrating on organisations whereby profit is one of their main objectives. Now, for not-for-profit organisations, there are a number of different objectives that we need to take into consideration because of the fact that they are not-for-profit organisations. So in terms of these types of businesses then, they encompass a number of different types of organisations. So these could be charities, government bodies, public schools, or public sector organisations. As well as not seeking to generate profit then, they don't also tend to have shareholders either. So rather than maximising shareholder wealth, they often focus on non-financial objectives. Now, one of the key areas then for most organisations which are considered to be not-for-profit is value for money. And this is the most common performance measurement that these types of organisations would use. Ultimately, it's to determine whether or not what they're doing is offering value for money. Now, value for money then is concerned with getting the best possible combination of services from the least possible number of resources, thus maximising the benefits for the lowest possible cost. So, value for money objectives, we often refer to these as the 3 E's. So we have to consider economy, efficiency, and effectiveness. So what do we mean by these 3 elements? Economy, obtaining appropriate quality for the minimum amount of cost. Efficiency, using resources as wisely as possible, getting as much out of what goes into that particular organisation. And effectiveness is about doing the right thing to meet the organisation's objectives. So let's think about a question. A value for money approach measures performance in accordance with economy, efficiency and effectiveness. Which of the following would be an appropriate measure for efficiency in a school? Exam result achieved, staff costs per student, percentage change in staff costs from the prior year. Now the answer to this would be staff costs per student. Efficiency is about maximising the output generated from units of resource used. Efficiency as well can often be measured in terms of the cost of providing a service, so per unit, of resource used, per unit of output, or per beneficiary that has been served. So in here, maximising the output, maximising the use of that resource would be the staff cost per student. So that will be a good measure of efficiency. Exam results are about effectiveness, and changes in staff costs is all regarding economy.